Best index funds in May 2022. Index funds are popular with investors because they promise ownership of a wide variety of stocks, greater diversification and lower risk, usually all at a low cost. That's why many investors, especially beginners, find index funds to be superior investments to individual stocks. Some of the most watched indexes fill up the financial news every night, whether it's the Standard & Poor's 500, S&P 500, the NASDAQ Composite, or the Dow Jones Industrial Average. These indexes are often shorthand for the performance of the market, and investors track them to get a read on how stocks as a whole are faring. Here's everything you need to know about index funds, including 10 of the top ones to consider adding to your portfolio this year. Best index funds for May 2022. The list below includes index funds from a variety of companies tracking a variety of broadly diversified indexes, and it includes some of the lowest cost funds you can buy and sell on the public markets. When it comes to index funds like these, one of the most important factors in your total return is cost. Included are 3 mutual funds and 7 ETFs. Number 1, Fidelity Zero Large Cap Index, FNILX. The Fidelity Zero Large Cap Index Mutual Fund is part of the investment company's foray into mutual funds with no expense ratio, thus its zero moniker. The fund doesn't officially track the S&P 500, technically it follows the Fidelity US Large Cap Index, but the difference is academic. The real difference is that investor-friendly Fidelity doesn't have to cough up a licensing fee to use the S&P name, keeping costs lower for investors. Expense ratio, 0%. That means every $10,000 invested would cost $0 annually. Number 2, Shelton NASDAQ 100 Index Direct, NASDX. The Shelton NASDAQ 100 Index Direct ETF tracks the performance of the largest non-financial companies in the NASDAQ 100 Index, which includes primarily tech companies. This mutual fund began trading in 2000 and has a strong record over the last 5 and 10 years. Expense ratio, 0.5%. That means every $10,000 invested would cost $50 annually. Number 3, Invesco QQQ Trust ETF, QQQ. The Invesco QQQ Trust ETF is another index fund that tracks the performance of the largest non-financial companies in the NASDAQ 100 Index. This ETF started trading in 1999, and it's managed by Invesco, a fund giant. This fund is the top-performing large-cap fund in terms of total return over the 15 years to September 2021, according to Lipper. Expense ratio, 0.20%. That means every $10,000 invested would cost $20 annually. Number 4, Vanguard S&P 500 ETF, VOO. As its name suggests, the Vanguard S&P 500 tracks the S&P 500 index, and it's one of the largest funds on the market with hundreds of billions in the fund. This ETF began trading in 2010, and it's backed by Vanguard, one of the powerhouses of the fund industry. Expense ratio, 0.03%. That means every $10,000 invested would cost $3 annually. Number 5, SPDR S&P 500 ETF Trust, SPY. The SPDR S&P 500 ETF is the granddaddy of ETFs, having been founded all the way back in 1993. It helped kick off the wave of ETF investing that has become so popular today. With hundreds of billions in the fund, it's among the most popular ETFs. The fund is sponsored by State Street Global Advisors, another heavyweight in the industry, and it tracks the S&P 500. Expense ratio, 0.095%. That means every $10,000 invested would cost $9.50 annually. Number 6, Vanguard Russell 2000 ETF. The Vanguard Russell 2000 ETF tracks the Russell 2000 Index, a collection of about 2,000 of the smallest publicly traded companies in the US. This ETF began trading in 2010, and it's a Vanguard fund, so it focuses on keeping costs low for investors. Expense ratio, 0.10%. That means every $10,000 invested would cost $10 annually. Number 7, iShares Core S&P 500 ETF, IVV. The iShares Core S&P 500 ETF is a fund sponsored by one of the largest fund companies, BlackRock. This iShares fund is one of the largest ETFs and it tracks the S&P 500. With an inception date of 2000, this fund is another long-tenured player that's tracked the index closely over time. Expense ratio, 0.03%. That means every $10,000 invested would cost $3 annually. Number 8, Schwab S&P 500 Index Fund. With tens of billions in assets, the Schwab S&P 500 Index Fund is on the smaller side of the heavyweights on this list, but that's not really a concern for investors. This mutual fund has a strong record dating back to 1997, and it's sponsored by Charles Schwab, one of the most respected names in the industry. Schwab is especially noted for its focus on making investor-friendly products, as evidenced by this fund's razor-thin expense ratio. Expense ratio, 0.02%. That means every $10,000 invested would cost $2 annually. Number 9, Vanguard Total Stock Market ETF, VTI. Vanguard also offers a fund that covers effectively the entire universe of publicly traded stocks in the US, known as the Vanguard Total Stock Market ETF. It consists of small, medium and large companies across all sectors. The fund has been around for a while, having begun trading in 2001. And with Vanguard as the sponsor, you know the costs are going to be low. Expense ratio, 0.03%. That means every $10,000 invested would cost $3 annually. Number 10, SPDR Dow Jones Industrial Average ETF Trust, DIA. You don't have a lot to choose from when it comes to ETFs tracking the Dow Jones Industrial Average, but State Street Global Advisors comes through with this fund that tracks the 30 stock index of large cap stocks. The fund is definitely one of the earlier ETFs, having debuted in 1998, and it has tens of billions under management. Expense ratio, 0.16%. That means every $10,000 invested would cost $16 annually. Why are index funds so popular? Index funds based on major indexes are popular for many reasons. These funds offer a good return over time, they're diversified and a relatively low risk way to invest in stocks. Like all stocks, major indexes will fluctuate. But over time indexes have made solid returns, such as the S&P 500's long-term record of about 10% annually. That doesn't mean index funds make money every year, but over long periods of time that's been the average return. Diversification. Investors like index funds because they offer immediate diversification. With one purchase, investors can own a wide swath of companies. One share of an index fund based on the S&P 500 provides ownership in hundreds of companies, while a share of NASDAQ 100 fund offers exposure to about 100 companies. Lower risk dash. Because they're diversified, investing in an index fund is lower risk than owning a few individual stocks. That doesn't mean you can't lose money or that they're as safe as a CD, for example, but the index will usually fluctuate a lot less than an individual stock. Low cost. Index funds can charge very little for these benefits, with a low expense ratio. For larger funds you may pay $3 to $10 per year for every $10,000 you have invested. In fact, one fund, listed above, charges you no expense ratio at all. When it comes to index funds, cost is one of the most important factors in your total return. While some funds such as S&P 500 or NASDAQ 100 index funds allow you to own companies across industries, other funds own only a specific industry, country or even investing style, say, dividend stocks. If you love similar content like this, take a look at my other videos and if you like it, please smash the like button and make sure you subscribe to the channel and hit the notification bell. If you have further questions, feel free to comment down below. See you in the next video.